Okay, so you want to own a movie theater. You picture the marquee lighting up your name, red velvet seats, the smell of butter drifting into the lobby, opening night with a line out the door for the next big blockbuster. You're the neighborhood's cultural hub. People fall in love in your theater. Kids have their first date there. You're not just running a business, you're running a piece of Americana. Here's the problem. Almost none of that is how this business actually works. The illusion is that a movie theater makes its money from movies. It doesn't. Not really. And once you understand why, the whole fantasy starts to crack. Let's talk scale first. The North American box office pulls in somewhere between $8 and $9 billion a year. There are roughly 5,700 theater sites and around 39,000 screens across the U.S. Sounds massive, right? Now here's the undercut. The average theater operates on a net margin of about 2 to 5%. Not 20, not 15. Somewhere between 2 and 5. A business that moves this much money and keeps almost none of it. That's not an accident. That's the entire structure of the industry. And movie theater isn't one business anyway. It's 3 or 4 businesses wearing the same name. You've got the mega chain multiplex, AMC, Regal, Cinemark style, high volume, wafer-thin margins, heavily leveraged on real estate and debt. You've got the boutique art house theater, lower volume, higher ticket price, survives on loyalty and local goodwill more than raw numbers. You've got the luxury dine-in concept, recliners, in-seat service, a bar, higher revenue per seat, but a brutal cost structure to match. And you've got the second-run discount theater, which is basically a different business entirely. Buy the movie cheap once demand has already peaked, sell tickets for $4, make your real money at the snack counter. 4 theaters, 4 completely different financial personalities, one word covering all of it. Now the cost to actually open the doors. If you're building or heavily retrofitting a mid-size multiplex, say 8 to 12 screens, you're looking at land and build-out costs somewhere between $3 and $8 million, depending on whether you're leasing shell space or building from scratch. Digital projection and sound systems run $70,000 to $120,000 per screen. Seating, especially if you're going recliner style to compete, adds another $1,500 to $3,000 per seat. Concession equipment, POS systems, permits, liquor licensing if you want a bar, tack on another $200,000 to $500,000. All in, a modern mid-size theater can run you anywhere from $4 to $10 million before you've sold a single ticket. That's the moment most people's fantasy quietly dies. So where does the money actually come from? Here's what nobody outside the industry really internalizes. Ticket sales are the weakest part of the business. Studios take a massive cut of box office revenue, especially in the first few weeks of a film's run. Often 50 to 60% of ticket revenue on a brand new release goes back to the studio. On some blockbuster opening weekends, theaters are effectively working for free or close to it, just to have the movie on their screen at all. That percentage does shift in the theater's favor the longer a film runs. By week 4 or 5, the split can flip to 80 to 20 in the theater's favor. But by then, most of the crowd has already come and gone. So layer 2, concessions. This is the real business, a bucket of popcorn that costs the theater maybe 60 cents to make sells for $7 to $9. That's not a markup. That's a different universe of margin, often 85 to 90% gross margin on concessions, compared to that low single-digit margin on the box office side overall. Here's the catch, nobody says out loud. Your ticket is basically the cover charge to get you into the room where the real transaction happens. Layer 3, deeper still, advertising and pre-show revenue. Theaters sell those 5 to 10 minutes of ads before the trailers to local businesses and national brands, and that's close to pure profit. No product cost, no labor beyond what's already on shift. Layer 4, private rentals, corporate buyouts, and alternative content, sports events, concert films, anime simulcasts, which theaters increasingly lean on to fill dead weeknight hours when regular attendance would otherwise leave the room empty and the lights running for nobody. Here's the insider trick almost nobody outside the industry has heard of: the concession attach rate game. Chains actively design snack bar layout, portion sizes, and combo pricing to nudge you toward the largest size for a marginal price increase, because the incremental cost of extra popcorn and syrup is close to zero, but the price jump captures almost pure profit. It's the same psychology as a gas station soda fountain. You're not paying for more product. You're paying for a decimal point shift in an already 90% margin item. Now the daily bleed. Labor is constant whether the theater is packed or empty. Ushers, projectionists, concession staff, cleaning crews. Utilities are brutal. Massive HVAC loads to keep large dark rooms cool. Projector bulbs alone can cost $300 to $1,000 each and need regular replacement. Film licensing and booking fees eat into whatever the studio split leaves behind. And if you finance that multi-million-dollar build-out, you're carrying interest that doesn't care whether Tuesday's 2 p.m. showing sold 4 tickets or 40. A theater doesn't get to pause its costs on a slow week. The rent doesn't know it's a Tuesday in February. The structural risk sitting underneath all of it is release windowing and studio dependency. Your entire revenue model depends on studios continuing to prioritize theatrical releases over streaming-first strategies. When a studio decides to shrink the theatrical window or send a film straight to a streaming platform, that's not a bad quarter for you. That's a fundamental threat to the business model itself, because you have zero control over it. You don't own the product. You rent access to it, at their terms, on their timeline. For a real case study, look at what happened to the AMC theater chain through 2020 and 2021. The pandemic didn't just hurt attendance, it exposed exactly how thin the margin cushion actually was. AMC came within weeks of bankruptcy in early 2021, kept alive largely by a wave of retail investor stock purchases rather than the underlying box office business recovering. By the time attendance did climb back, the chain was carrying billions in debt it had taken on just to survive the closures. It's a case study in how a business with razor-thin operating margins has almost no runway when its single revenue stream, people physically walking through the door, gets shut off, even temporarily. So how do the smart operators do it differently? They don't think like a single location owner. Big chains use scale to negotiate better film splits and bulk concession pricing that a standalone theater could never touch. Some real estate-savvy operators actually treat the land itself as the asset. The theater is almost a placeholder use, and the real play is long-term appreciation or eventual redevelopment of a prime retail lot. And the smartest independent operators lean hard into what a streaming service literally cannot replicate: event experiences, live Q&As, themed nights, retro screenings, things people will pay a premium for, precisely because you can't get it on your couch. Let's do the math both ways. Good year. A well-run mid-sized theater with strong concession sales might net $400,000 to $700,000 on the year, mostly on the back of 2 or 3 summer blockbusters and a strong holiday season carrying the whole calendar. Bad year. A weak release slate, a couple of major films delayed or pulled to streaming, maybe a competing theater opens nearby. And that same location can post a loss of $100,000 to $300,000, even with attendance that looks perfectly normal on paper. Same building, same staff, same popcorn machine. Completely different outcome, driven almost entirely by decisions made in a studio boardroom you have no seat at. So is it worth it? Depends what you're actually buying. If you're going in expecting the ticket booth to make you rich, this will quietly ruin you. The margins are too thin, and the studio split too punishing for that math to work. If you understand from day one that you're really running a concession and experience business that happens to have a screen attached to it, and you have the capital cushion to survive a bad release year or two, there's a real sustainable business here. It rewards operators, not dreamers. There's one more layer people forget to ask about: the real estate underneath the theater itself. Most operators don't own their building outright. They're leasing on long-term deals, often with rent tied to a percentage of gross revenue on top of a base rate. That means even in a bad year, When box office is down and concessions are soft, the landlord still gets paid first. Your lease doesn't care about your margin. And streaming isn't just a future threat, it's already reshaping the math in real time. Films that once had a guaranteed 75 to 90-day theatrical window before hitting home video now sometimes get 30 to 45 days, or in some cases a same-day streaming release. Every day shaved off that window is a day theaters lose the one reason people had to leave their couch. You're not just competing with the theater down the street anymore. You're competing with the customer's own living room. The movie theater was never really the product. It was the popcorn and the 2 hours of somewhere to eat it.